What do investors buy to stay safe? And which maturity? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to a weekly bond update. This was another quite eventful week in the markets. So let's talk about what's been top of mind for the financially savvy savers in our community. Here are the three topics that we'll be covering in today's video. 1. What major milestones and events moved markets this week? 2. How did Treasury yields end the week? And this section is very interesting. There were so many major headlines in the news this week that it was more difficult than normal for Treasury yields to be in the spotlight, which is probably why no one noticed what was happening in a certain corner of the bond market. And if they did notice, it did not appear to be newsworthy enough to report, it seems. But that's why you have us here at Diamond NestEgg. And 3. What are the yield expectations for the upcoming week's Treasury auctions? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What major milestones and events moved markets this week? It seems the old adage, all good things come in threes, applied to this past week, at least initially. First, the week started on a positive note when the US and China both confirmed that they were de-escalating their ongoing tariff dispute and focused on reaching a deal that both sides could live with. And as a first step, China promised to resume shipments of rare earths to the US, while the US, in turn, will ease visa access for Chinese students who want to study at our universities, and also relax some export controls. Second, the Bureau of Labor Statistics announced better than expected inflation readings. Both the Producer Price Index and the Consumer Price Index were up only 0.1% versus the previous month. This also meant that consumer price inflation on an annual basis remained near its 4-year low of 2.4% from April, already quite close to the Fed's 2% target, while the Producer Price Index wasn't that far off at 2.6%. In addition, real average hourly earnings for all employees increased 0.3% in May. And third, the University of Michigan released its index of consumer sentiments for June, which showed a steep improvement for both current economic conditions and consumer expectations from low points in May. This improvement in consumer sentiment seems to confirm the low and stable consumer price inflation data. Consumers that had expected dramatic price increases from the Trump tariffs just haven't seen them, at least not yet. JP Morgan even issued a cautiously upbeat outlook. While it is still possible that some inflation will show up later in the summer, the fact that we have not seen an impact so far is encouraging. It's becoming increasingly evident that the economy is more resilient to higher tariff rates and general uncertainty than some anticipated, and we maintain our belief that it can continue to expand. Now, if you think at this point that this all sounds too good to be true, you're right, because on Friday, Israel struck the Iranian regime and its nuclear capabilities, and it initially seemed that all cards were up in the air again. In the end, though, the reactions in the equity markets to this escalation were, maybe a bit surprisingly, rather muted as of the close of market on Friday. The Nasdaq, the S&P 500, and the global Dow equity indices were all down by a bit more than 1% on Friday, as you can see here, which is a noticeable reaction, but not really a market crisis. Oil prices reacted more severely and jumped by 7.6% for the day, reflecting concerns that a wider Middle Eastern conflict could potentially disrupt shipment of oil out of the Gulf to customers all over the world. At the time of this taping, though, oil is still a bit cheaper than it was a year ago, and the confrontation between Israel and Iran hasn't ended yet. The hostilities and accompanying tensions and uncertainties may remain with us for a while. Plus, as those of us in the universe of bonds know, the equity markets don't necessarily always tell the full story, bringing us nicely to the next section of today's update video. How did Treasury yields end the week? For most bond investors, whenever someone shouts geopolitical crisis, we hear safe havens, because historically when there are global crises and conflicts, investors tend to flee to safe havens, including gold, the dollar, and perhaps even more so, Treasuries. This sudden spike in demand for these safe haven assets normally means that their prices will rise. And indeed, as expected, both gold and the dollar went up in price. Not dramatically so, but noticeably. Gold was up 1.48% for the day, and the Wall Street Journal Dollar Index was up by 0.3%. But what was a bit surprising this time was that bond prices didn't go up. Quite the contrary. Prices for Treasuries fell on Friday, which meant that their yields went up, as you can see here. Remember, price down, yield up, the fundamental mechanism of bond investing. That said, yields didn't go up by much, but still they definitely moved in the opposite direction of what you would normally expect in times of crisis. Now, this unexpected rise in bond yields on a day of crisis caused a bit of soul searching in the market, as Market Watch reports why bonds aren't acting like a safe haven for investors amid the Israel-Iran conflict. Treasury yields were rising, not falling, on Friday as the US dollar and gold saw haven buying. And in case you're curious, the article doesn't come to any convincing reason or conclusion for why bonds weren't acting like a safe haven on the news of a potential geopolitical crisis, at least not beyond the often quoted budget deficit issue and uncertainty about Trump's tariffs. So let's talk a bit about what we saw in the numbers, because as important as it is to know what's happening day to day, it's equally important to understand the overall trend. And let's have a look at our usual table with Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. With the exception of the 1.5 month, 2 month, 3 month, and 4 month, which were up for the week, all the other maturities were down. So overall, it doesn't seem that investors were fleeing from Treasuries. If anything, they might even have increased exposure to the safety of Treasuries. But what probably stood out to me the most was the 1-month Treasury bill. It closed out the week with an almost record low yield of 4.23%. And this 4.23% is even below the current target Fed funds rate range of between 4.25% and 4.5%, despite market expectations that the Fed will not cut rates this coming week. Why, you might ask? What's going on here? Well, in our mind, this, the 1 month or 4-week T-bill, may be the maturity that investors are currently buying with their safe money, as I know some of you in our community have been doing, when the going gets tough and shaky in the market, so to speak. Between Wednesday, June 11th and Thursday, June 12th, the 1-month T-bill fell 12 basis points, which is a major downward move for the 1 month, as you can see here. And for those of you who are wondering, June 11th was the deadline that President Trump had set for Iran to come to a deal on its nuclear weapons, or else. And according to the Wall Street Journal, Iran let the deadline pass while taking a more defiant stance. The head of Iran's atomic agency, Mohammad Eslami, said Tehran would accelerate its production of near-weapons-grade uranium and open a previously unrevealed enrichment site in what he said is a secure location, according to Iranian state media. We don't know for sure, but this deadline that Iran chose to let pass might have made the market nervous already. And the price movement of the 1 month seems to confirm our instinct that Treasuries remain a safe haven in times of crisis, that investors still bought Treasuries when they got nervous, just that it was at the very short end of the spectrum, instead of the more familiar benchmark 10-year at the longer end. So, if you find yourself pondering headlines like this one and worrying about whether Treasuries are still safe, which I know some of you are based on the comments we've seen, it appears that there's at least a segment of the market that believes Treasuries are indeed the safe investment of choice in times of instability. That said, only time will tell, but this could be an interesting week. If the 1 month T-bills stay at these levels below the Fed target rate range, or if their yields go down even further, then the Fed may have no choice but to either cut rates, something that the market doesn't expect at this point, or go out into the market and buy up some of these very short-dated T-bills to get their yields back up and in range again. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The 2-month through the 6-month, as well as the very long-dated 20-year and 30-year T-bonds are up, while the 1 and 1.5 month and the maturities between 1 year and 10 years are down. These mixed results show a high level of overall market uncertainty, with the short end decline in yields over the past few days potentially driven by the flight to safety reaction to the Israeli strikes, as we just discussed. And the long end rise in yields could be due to a multitude of factors, from moderating inflation and a strong improvement in consumer sentiment to improved tariff and trade talks and the lower probability of a recession. In other words, the yield curve may just be slowly uninverting. Now, as we all know, these are somewhat crazy times we live in, and as always, things could change very quickly. So as customary, we'll keep our eyes and ears on things and keep you posted as things evolve. Do also keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that you know where Treasury yields ended this week, let's move on now to the next section of today's video. What are the yield expectations for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that all the weekly T-bill auctions are happening as usual. And if we scroll down, we can see that the 20-year T-bond and the 5-year TIPS will also be auctioned off this coming week. Both of these are reopening auctions, so we already know the coupons on those. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. And here's the coupon and the expected yield for the 20-year T-bond auction. Keep in mind that the last time the 20-year T-bond had a 5% coupon before this auction and the previous one was in October 2023. So for those of you who've been waiting for a 5% coupon on a longer dated T-bond, this may be one to consider dollar cost averaging into, if it fits your personal situation. And here's what the coupon and the expected yield are for the 5-year TIPS auction. And as a point of reference, this expected yield is higher than the current fixed rate on an I-bond. So if you're comfortable with TIPS, this may be something to take a closer look at. Bond beginners, folks, please refer back to these two modules here on TIPS and I-bonds for a refresher. The break-even inflation rate on the 5-year TIPS was 2.31% at the close of market on Friday, which is in line with the break-even inflation rates on 5-year TIPS for all the years post-COVID, but a fair bit higher than the break-even inflation rates that we've seen on the 5-year TIPS in the years pre-COVID. And as we mentioned earlier, the latest BLS inflation report showed annual inflation coming in at 2.4%. So if the 5-year TIPS fits your timeline, goals, and expectations, and you want to add some inflation protection because you believe that inflation over the next 5 years will average more than 2.31% annually, then this may be an auction to consider dollar cost averaging into. Please also keep in mind that all of these Fidelity numbers can and usually do change all the way up to the time of the auction. All right, members, super savers, and Bond Course fans, I hope you enjoyed today's video and learned something new. And for those of you who subscribe to Your Financial Journey, check out this latest video here from Ava on the average income by age from ages 16 to 75 to see where you fall, as well as some ways to give your financial journey a boost if you're so inclined. And as always, if you want to learn more about bond investing and building out a bond portfolio while rates are still attractive, then check out this video here on our bond courses. I've also linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. And see you again very soon with more brand new wealth building content for your financial journey.